Jazzcast Pros.
Hello there, my graceful grinders and totally uniquers. It's your girl, Dr. Pamala Brown-Grinion, here today for another wonderful episode of the Grace and Grind podcast. I have with me as my special guest, CJ Francis-Eronini. Doesn't that have a nice ring to it, ladies? All right, and he is one of the chairman of YU Financial. So CJ, welcome to the platform.
Happy to be here. I appreciate the invite. Finally.
Yes. We met with one of the other partners when we talked about Smart Lock in a different format of conversation. Today, we're going to talk about how to use Smart Lock as a single premium final expense insurance asset. And so, stay tuned. Like, share, subscribe, leave us comments, and most of all, tell somebody about this podcast because we need to change the financial lives of our community. And this is a great way to do it. So, CJ, can you tell us a little bit about what Smart Lock is and what problem were you trying to solve when you created it?
Yeah. So, like you said, Smart Lock, simply put, is a single premium insurance asset, right? So that at its basic core, that's what it is. What I saw, what I noticed, and I'll start with my why. When I was 2 years old, my father passed away. He was a young guy. He was actually in New York. I know you're in New York. So I was born there, and he had insurance, right? He had insurance policies, one of which lapsed before he passed away, another which did not pay out after he passed away. And so, I got into this industry doing a lot of different things with insurance. As I'm sure there's a lot of different markets, aspects of insurance. And I've done them all, right? Mortgage protection, final expense, IULs, VULs, infinite banking, done all that stuff. But what I noticed is that a lot of people don't actually get the value of insurance, right? It's one thing when you are buying insurance or you're getting told, this is what your insurance will do or can do, right? But what matters is what do you have when you need it, right? That's what matters. So that was really something as I've been in the industry over, years, I've seen clients have insurance, love it, love the concept, but lose it because they can't pay for it. They lost their job, even like work insurance that people have, change jobs, retire. Now you lost it. Term insurance that people will have, they'll keep it, even if you pay it for however long, 10, 20, 30 years, once you're done paying it, now you don't have insurance and now you're way older, right? So now insurance is way more expensive. And so that was really the problem. I wanted to make sure that, like you said, our community, especially a lot of times, whether or not we know it, insurance is something that we are lacking, right? We're lacking it. It's why a lot of people end up in very bad situations when someone passes away. So we just wanted to find a solution that people knew they would have something. Right? We like to say, get it and forget it, use it, don't lose it. Just make sure that you have something, no matter what it is, right? Start with something that you're not going to lose, and then kind of go from there. So that was the problem that we wanted to fix.
Wonderful. Just to piggyback off of a part of your answer, you said term insurance. And I know some people believe that I can buy term now and then invest the difference so I don't buy whole life, or when I get older, I should have more assets that I should be able to use to pay for insurance versus, looking into the single premium. What do you say about that buy term and invest the difference and how people are impacted in the market as a result of that?
Right. So one thing, first of all, we don't really poo-poo anything else. There's a place for everything, right?
Exactly.
So there's a reason why someone would do a term. There's a reason why someone would do infinite banking, whatever, right? But, to answer your question, you said a word that's very key when you were just explaining that to me. You said the word should, right? Should. I should be able to have my investment pay for what I need. I should be. We don't know what's going to happen, right? And so that's a very big deal to me. Once again, I'm someone that lived that, right? My dad was in a position that I probably shouldn't have had to do a lot of the things I had to do. And my mom shouldn't have had to do a lot of things she had to do. But we didn't know that he was going to pass away when he passed away. And so it's very important, once again, to plan for all outcomes, all possible outcomes, right? I should be able in 30, 40 years to be able to have that. But what if I don't live that long? Who knows? What if you get sick? What if you stop working? What if your investment tanks, right? We don't know what's going to happen. And so that's really where we want to put it. I personally think that's where insurance should be put, because all those other things are good, right? Investments are great. Do these things, right? Real estate, crypto, whatever, do them, right? but put insurance in a place where you know you're going to have it and not something that's competing with those things. And I think a lot of times, whether it's term and invest the rest or whether it's infinite banking, it's usually like I'm deciding, what am I doing? Am I doing this or am I doing that? Right. And I think that, with this and what we're doing, it's not that. It's just putting it in its rightful place and then letting it grow as it grows. So,
right.
Yeah.
So in essence, you are helping people to rethink about or change their mindset about the concept of insurance. Why do you believe the traditional approach to life insurance and retirement planning is broken or maybe even incomplete?
A couple reasons. I think a lot of people pitch things that maybe they don't fully align with or understand. So a lot of people, most of the time when you're getting insurance, you're going to a broker, right? Maybe you'll go to a website or something like that. For the most part, you're talking to someone. And so when you're talking about, what you need to do to buy insurance, right? I'm trying to find your budget. I'm trying to figure out what it is you can afford. I'm trying to do those we call it financial needs analysis, right? Where we're digging into your finances, your income, your debt, all this kind of stuff. A lot of times, once again, we're looking at today's snapshot, right? So because we're looking at today's snapshot, maybe that works today, but if it breaks tomorrow, because once again, someone loses their job, right? Unexpected expense that comes out of nowhere, happens all the time, right? It breaks the formula that we use to get whatever insurance we had, right? And that's really the problem because once again, we're really anticipating, right? We're saying, okay, we think that you'll need this amount. We think that you'll have this amount to pay. We think that your investment will do this or that. We don't know. None of us know, right? And so at the end of the day, that's really the issue that we want to solve. And when we talk about insurance being broken or even finances in general, most people's financial situation is because they're making decisions on today and they're not really looking at what could possibly happen, right? And we want to avoid that. We want to get people in positions where they're setting themselves up, once again, for all possible outcomes. And that's really all we do. That's all we want to, focus on.
So let's say I have a lump sum of money, right? How would you help me turn my lump sum of money into lasting protection?
Perfect. So we have a concept, we call it your absolute minimum, right? And so, we'll ask this question. We'll ask, well, if something happened to you, got sick, passed away, or, right, you lost almost everything you had. So that lump sum could be in an investment, even it could be in savings, whatever. What is the absolute minimum amount of money that you would want your family to have, right? In case something were to happen to you. And most people are going to have an answer based on whatever it is, whether it's retirement, whether it's come from savings, whether it's come from anywhere, right? And so we'll take that money and we'll repurpose it. We'll use a smart lock, which once again is a single premium multiplier of that money. Okay, it does two things. A, it'll protect that money because it grows with guarantees. So you're not going to lose it, right? It's kind of like a hedge against the other things that you might be doing, whether it's investments or your retirement account or whatever. But then also there'll be an insurance multiplier, right? Instantly. So that number that I had as my absolute minimum, once I do the transfer, is now 2 times, 3 times, 4 times, whatever that minimum is. And I know I'm not going to lose it. And so worst case, even in 30 years, 40 years, 50 years, whenever, that happens, your family knows they have at least this. That's not going to be, taken, or I'm not going to lose it. I'm not going to lose coverage. And now you're able to kind of build a portfolio. We like that, sort of verbiage where now you can add on to it as you go. So now I come into more, or I want to, I change jobs, whatever. I take another loan from my 401k, whatever I do, I'm able to sort of add to it as I go and make that nest egg bigger and bigger and bigger. And not only is it a nest egg, once again, I'm also protecting that money. So that's kind of how we deal with the lump sum.
Wonderful. So in other words, you're saying, let's say I have this $150,000 lump sum and I want to borrow against my 401k, put this money into a smart lock policy. You mean my death benefit will be 2 to 3 times my initial amount of my 150. So that would be the amount that my family could anticipate should anything, unfortunately, if I meet my unfortunate demise, untimely, unfortunate demise, that my family would have 3 times the amount that I initially started with.
Correct. And not should anticipate, will get.
Will get. That's amazing.
Yeah, that's a big deal. So yeah, you got it.
That's amazing. So in a previous conversation that we had, you were talking to me something about a two-way street, that you were describing insurance as a two-way street. Can you explain to my listeners what you meant by that?
Of course. So It's interesting. One of the things at our company that we really focus on, and I think you hinted at it a little bit, is kind of rethinking and changing the way people think about insurance, right? And so, most people look at insurance top down. So I'm a parent and I now am a parent, right? So I lived through it where my family didn't get it. I now have children. And so I'm looking at my children, I'm looking at my wife, and I want to protect them, right? God forbid something happens to me, like you said, untimely, something unexpected happens. I want to make sure that they're, protected. And that's where 99% of people are going to put insurance, right? But there's another flip to insurance that a lot of people don't really think about, and it's bottom up. Okay. A lot of people, me included, have parents. My mom is still alive, right? God forbid something happens to my mom. I'm her oldest child. It's on me. I've got to figure it out. So usually what's going to happen is GoFundMe, right? You got to go to the church, you got to, just ask your family for money, whatever the case may be. A lot of people, a lot of children, let's say, don't prepare for that, right? You're preparing for you, but you're not preparing for what you're going to have to deal with when it comes to parents and that kind of stuff. And so that's another way that we help people, where they can do this same concept, own it, use it as their asset, protect their money, but they're doing it with their parents in mind, on their parents, so that they are receiving it. All right. And they're able to now say, okay, I've actually leveraged my minimum amount of money that I want to put on my parents, so that now whenever that happens, I don't have to do a GoFundMe. I don't have to go, beg for money or go ask for whatever, whoever. Right. And now my family coming down is in a better position. And so two-way street is kind of our way of explaining that. Once again, most people top down, they understand that. Whether or not they do it, that's a different, scenario, as we all know. But bottom up is something that a lot of people just will not think about. And we want to make people think about that, especially younger people, 30s. You want to make sure you're thinking like that, because it is something that we see. It happens all the time.
Yeah. And, it's so true, because I remember when my mom passed away and she had a minimal insurance policy. And I was thinking, you're a licensed life insurance agent. Like, this didn't click. It never registered with me to have insurance on my mom. But I have since told my children that they can put insurance on me if they want. They can pay for the policy and do all that. I will not fight against that. Just don't try to knock me off for the money. We might have a little problem there. But yeah, I'm okay with it. Instead of thinking, what are you leaving me, mom? Like, are you going to leave me anything? And I'm like, you put insurance on me, you can leave yourself something. You pay the policy, it's going to you, right? So yeah, that is so very true. And I didn't have that aha moment until it was too late. But I did, tell my, my responsible children, that is, right. Not the ones that I think would knock me off, because I got one or two, CJ, that, might be like, mommy worth more dead than alive. Like, let's conjure a plan,
That's funny.
You got to sleep with one eye open, one eye closed on a couple of those jokers, okay?
That's funny.
As I was saying, I had this aha moment after the fact, and you're talking about using insurance as this two-way street, especially the smart lock. So who would be the ideal candidate for this smart lock asset?
Right. So, there's a lot of different use cases that we have with this, the final expense sort of use case. Once again, because it's a two-way street, it really doesn't matter, right? If somebody has some lump sum of money somewhere, and a lot of people think that that's not them, right? But a lot of people are working, so they have a retirement account, right? A lot of people have something saved somewhere, right? Or can get it from somewhere. And so anybody like that can do a one-time transfer to get something is an ideal client, right? Either you're doing it for your parents or on your parents, or you're doing it for your kids. Either way, you own it, right? So you own it, you're protecting your money. So even in the scenario with your parents, right? If I do a transfer or a loan from my retirement account, I'm the owner of the smart lock. And so it's my money, it's my asset. I can access it, right, while I'm alive, and my parents are going to be covered. So, that doesn't take out someone from doing it that's younger, right? I'm 30, I'm 25, whatever the case may be. But I would definitely say, yeah, if you have a lump sum, if you're working, most people that are working and are contributing to some kind of retirement account or saving in some way, insurance is something that they can definitely look at. And especially in this way where it's not a bill, it's an asset, right? A true asset that you own. And now you can kind of, whether it's your parents or you, protect your family. So
Right. So your life insurance is not going to be on monthly layaway payments.
exactly. Trying to decide between eating and paying for your life insurance. That's a lot of the decisions people make, and it doesn't make sense. That's not smart.
Yeah. Yeah. I been there, done that, and still doing it. Okay. In some regards. But like you said, all of this diversification, regardless of what type of asset you have, they all work together in concert. So, having that is a good thing versus not having anything. Right. Yeah. So, how do you help clients? Well, no, let me back up and ask this question. You mentioned people can borrow from their 401k. What are other places where people can get money in order to acquire a smart lock asset?
So in this scenario, with this use case where we're talking, we call it an insurance hedge, forever insurance hedge. Of course, the most obvious one, easy one is something like savings, right? I've got savings somewhere. Liquid assets, things like CDs, money market accounts, investment accounts, of course. You mentioned the 401k loan. That's a very popular way to do it because it's a smart way for you to access money without, having to pay a tax on it. And the repayments and the interest on it is just replenishing your 401k. So it's really like a revolving funding sort of mechanism for it. So that's cool. Also, if you've got existing insurance, right? Existing cash value insurance, that's a way where we'll 1035 it into it. It stops the premiums that you're paying. So that's really another use case for this. A lot of people that have monthly things that maybe, cash flow is tight. They don't want to keep paying on this. They want to keep, whatever coverage or something, right? So we can take the cash value from whatever they've got existing and put it into a smart lock. And that's also a good way. Actually, just yesterday, we were dealing with a client. I actually had never done this, but with a client that had an annuity. And what they did is their annuity allowed them every year to take out a certain percentage of it without penalty. And so we did that, right? So we took, I think it was like 10% of it and, are funding a smart lock with that. So there's lots of ways, right? Once again, if you've got some kind of lump sum somewhere, and most people do, if they really think about it, there's a way we'll be able to access it. We've done all types of things, right? We're able to help people with rollovers and do all types of stuff. But for this scenario, where we're doing it for insurance specifically, we want to make sure we're protecting some amount of your money. Those are the ones that we'll see, right? Super liquid assets. Typically, those are the assets that are first that your kid would get anyways, right? So if you've got like a home, that takes a while before your kid can access that or touch whatever. But something like savings, your retirement account, all that kind of stuff. We want to protect that or whatever that minimum amount is of that. And so, yeah, we'll find a way to be able to get that money.
So what if someone owns assets like real estate? How do you help them see the value in that?
Well, it depends, right? There's, once again, a lot of different ways we can go. You owning real estate doesn't change the fact that you've got a family. It doesn't change the fact that you've got something to protect, right? And so, we'll talk about the fact that you want to have something liquid, right? You want to have something liquid. People have told us, yeah, man, I've got real estate and that's my fallback. So in case something happens to me, my family's going to get my houses and my properties and yada, 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 which is okay. And that's real. And that's cool. But like I said, how long will that process take? I don't know. Right? I don't know. Are they going to sell it? Are they going to live in it? You can't live in 5 homes, right? Are they going to now take, a loan again? I don't know. I don't know what the situation is. And so really what we want to do once again is really make sure that someone has something liquid, right? That is quick, accessible. God forbid that worst case scenario happens, right? And that's where we talk about that minimum amount. We want to start with something that, I kind of give the analogy, God forbid something happened to that person and they look up from the grave and they can see what their family is doing, and their family has less than this amount, they would hate themselves. That's the amount we want to start with, right? How can we make something liquid, accessible, fast? And then, of course, all the other stuff, the real estate, the, retirement, the investments, all that, cool, right? But there's something quick that they know they'll be okay. They can pay for the funeral. They can pay some bills, pay the mortgage, whatever the case may be. And now you're putting your family in the best possible position when it comes to having insurance, but also protecting your money, right? Because that's a big part of it too, protecting your money. So, yeah.
Mm-hmm. So this sounds wonderful. This sounds like it's a no-brainer for anybody listening that they would want to take advantage of something like this, right? Like is there a certain amount that someone needs to start with? Is there what do you call it? An
Spectrum.
average or a spectrum. Yes, thank you. A spectrum that someone like from this minimum to this maximum. And then part two to that is what is there a maximum amount that I can put into this asset? So what is like the spectrum that I can use to start one? And then is there a maximum?
Yeah, so there's really not a minimum. And there's nuance based on who we work with, which partner, whether you can qualify based on your health and that kind of stuff. I like to tell people, because that's the question people think, and they kind of disqualify themselves. Oh man, I don't have this. I don't have a lump sum of that to give, right? I wouldn't even look at it that way. Once again, do you have something that you would not want your family to go without, right? We work with a bunch of different partners that we can find something that fits based on whatever that number is, right? We can figure out a plan, figure out a way to get to it, figure out a way to protect it, right? So there's really not really a minimum. I know what some of our like easier carriers to qualify for or faster, you might be looking at 5,000 and up, right? All the way up to like 5 million, right? So, that's a wide spectrum. For some of our other ones, down to a couple hundred, 1,000, where you can go all the way up. But once again, it's not really about, what the minimum is or what the maximum is. To me, it's more so what's that number, right? If I'm sitting down and I have kids, or I'm sitting down and I have parents, and I know that there's some amount that I want to make sure either one of those people, whenever they're in a situation where, the inevitable happens, they'll be okay. We'll go with that. And we'll figure out whatever that, situation looks like, how to do it, which partner to use, all that stuff after. But what's your why, right? What are you trying to do it? Why are you trying to do it? And then we'll go from there.
Yeah, I like the question of the minimum. Because most times people ask when you're sitting down with someone, so what's the maximum amount? Or they write down all of your bills and all of your, I've done it. I've done it because it seemed like that's how I was trained. And it seemed like the right way to go to make sure that people had the proper amount of coverage. But sometimes that can cancel people out. So if you ask someone, what is the minimum amount that you would want your family to have if you should meet your unfortunate demise tomorrow? Right? What would be that minimum amount? Then it will start to make insurance a lot more real and tangible for people because they're not thinking of, I want to leave $1 million. They may say, I want to leave $100,000 or I may want to leave 50,000. And it doesn't mean you need 50,000. You may only need 25,000 or 15,000 to acquire that 15,000, right? Because
Yep.
it's going to multiply immediately.
Yep. You got it. You got it. I think just to hit on that point real quick, a lot of people in this industry, my industry, financial services in general, like you said, are taught to say, how much can we move, right? For two reasons. It could be for the client. It could be for the person, right? We don't know. But I think it's very important to grasp that turns it into a bill. It turns into something that they have to keep up with, right? And so when you talk the way we talk, when we talk about minimum, and I bring people down, what is your minimum? Absolute minimum, right? Once again, I'd rather start with something that I need this and I'm good with this. Like, that can go away, right?
Mhm.
I know that's there. And then on your own time, voluntarily, you're able to add to that as you want to go. I think that's a way healthier relationship with insurance, right? And I've seen some very unhealthy relationships with insurance where people are doing crazy things to keep it and then end up losing it anyways, right? And so to me, I just think that it's just a far better way to make sure that people have something when they need it.
I really like that. I really like that. I really, really like that's hitting close to home for me, thinking about that minimum, and ever since you asked that question on Monday, I have really been thinking about what would be my absolute minimum, and that I can tangibly put my hand on that I could, you know what I'm saying?
Right,
Like
right.
that really made it hit home for me.
It hits home. When I did it, right, I did it over the weekend, and I was thinking, and I was like, "What is that number?" Because for me doing it, I'm looking at my wife, and I'm like, "Do I even know my number? Like, I need to make sure I know mine." And we talked about it. We all talked
Yeah.
about it. And it was like, "Okay, well,
Yeah.
this is a number, and vice versa. What's your number?" And it was like, "Wow." So we did that exercise, so I know me doing it myself. I know when I say it to somebody or talk to somebody, it puts you in a position, like you said, where you put insurance where it's supposed to be,
Yeah.
right? What is that minimum? I want to make sure I have this. Everything else, okay, God bless, we can invest, we can do this. It might grow 20%, it might do whatever. That's great, right? But we have this. And so now we've protected ourselves against whatever happens, right? We don't know, once again. And that's the whole point of insurance. You don't know. So if insurance is adding another layer of uncertainty with a bill or a term, I don't really think that makes sense, because the nature of it is to protect against the unknown. But itself, it becomes also unknown usually, right? I'm paying a bill and I don't know if I'll keep it up, right? I don't know if I'll outlive the term. I don't know. And so we want to remove as many of those factors as possible, once again, to put someone in the best position so that when that time comes, whether it's they get sick, they pass away, or even protecting their money, they need to access it, they've got it. It's there. Everything else is cool. We'll leave everything up for the other people.
Forever, you can't possibly lose it because you paid for it upfront 100%.
So like the status, when we do them, the status is paid up. So got it for life. You could do it now. What's the date? May 15th, 2025. May 15th, 2085. It's still there. The companies we do this with have been doing, and that's another thing, they've been doing this for a long time. And so, we work with companies 130 years old doing this. So it's there. It's not going anywhere.
Okay, so I have one more question that I'm thinking that somebody is going to be thinking when they hear this. So, because normally there's a wait period, right? So what if I buy a policy and in 2 weeks' time, I'm deceased? Is my family paid, or do I have to wait this 2-3 year thing?
It's paid up. So there's no graded period. Usually what you're talking about is called a graded period, right? Final expense, typical final expense policy. Usually that's because of health or whatever the case may be. So as long as there's not like fraud, right? You lied. You said, oh, I don't have heart disease. And then you died of a heart attack. As long as that's not the case, it's paid up. It's going to pay out. It's going to pay out to your family. So that's a big deal. Once again, it's a lot more lenient too. So the underwriting is a lot more lenient. A lot of people are qualified for this that cannot qualify for other things. You got to think about it from the insurance company's perspective. If I'm paying a monthly policy, right, and that situation happens, maybe I pay $100, $200, and all of a sudden my death benefit is $150,000. They're going to fight it. They're going to fight it. And that's what happens. I'm almost sure that's what happened with my dad, right? Where, okay, maybe he paid it for not that long, right? And then the policy that ended up staying and he passed, they fought it. My mom told me, they said no, right? What he said was the case was not the case. And so with this, once again, because I'm lump summing and paying it up front, they know they've gotten what they're going to get. It's paid up. And so they're going to pay out what it is they promise you, because that's the nature of the product. And that's another reason why we like this. It's there. We know what we're getting. We know it's there. That's it. We can add on as we go.
This was wonderful. Thank you so much for sharing with my listening audience and for helping to educate them on how to keep it graceful financially while you're grinding it out. This was such a great conversation. I'm so happy that we were able to finally make this happen. Finally. Thank you for being here. You know that you are appreciated.
Yes, ma'am. I appreciate you. Thank you for having me. For sure.
Absolutely. So there you have it, my graceful grinders. This is all we have time for today. And as I always say to you guys, always remember to create your totally unique day on purpose. And remember to keep it graceful while you're grinding. Until next time, Dr. Pamala is out.